Okay, so today we're going to be looking at Chapter 5. Chapter 5 deals primarily with inventory and cost of goods sold. In this chapter, we will look at two different methods. We will look at the Perpetual Method, which will be our primary focus, and then the Periodic Method is covered in the appendix. Similar to Chapter 4, if you are an accounting major or minor, you should probably review that is in the appendix. If you have any questions on it, feel free to come by. I'm happy to walk you through it. But it will most likely not be covered on your exam. In the event that does change, I will be sure to make an announcement in class, but if you are uncertain of if that will be covered or not for your section or for your semester, please let me know that, and I'll be happy to clear that up for you. Typically, we don't have time to cover both methods, which is why we lean toward the perpetual system, as it is the most common with the larger corporations, which is, of course, our focus in this course. So I will briefly discuss how periodic works, but I would not expect any extremely large or worked out type problems in the problem portion of your exam over the periodic method. I would think those will primarily be made up of worked out problems related to perpetual items. So of course you remember from Chapter 4, Perpetual versus Periodic Inventory Systems, perpetual being those that get updated every time there's a purchase and sale of inventory, and periodic being, of course, the method that only updates at the end of each period. So as you can see, we've got several learning objectives in this chapter, but before we can do anything with inventory, we have to really understand what inventory is and what is included in that inventory account. So the textbook gives a pretty good definition here, so we'll just read this one. Merchandise inventory includes, of course, all goods that a company owns and holds for sale, regardless of where the goods are located when inventory is counted. Now, of course, that last piece after that comma is dealing with those shipping terms. Remember, if we purchased something that was FOB shipping point, then even though we have not received it yet, that changed ownership from the seller to us, the buyer, the moment that was loaded on the truck. Because of that, what that tells us is that we are able to count those items on the truck as inventory at the end of the year, even if they don't arrive until, say, January the 3rd or January the 4th. So we see that happening here. Now, there are a couple of things that, of course, require our attention to really zone in on. The first being goods in transit, which we just talked about. Next is what's called goods on consignment. So we'll talk about that in just a moment. And finally, goods that have been damaged or are now obsolete. Once again, goods in transit. We've got our two methods, FOB shipping point and destination. Of course, FOB shipping point, the goods are included in the buyer's inventory as soon as they are shipped. And FOB destination, those goods will be included in the buyer's inventory only after arrival at the destination, which means conversely, as opposed to FOB shipping point, those goods will still be the property of the seller until they actually have been delivered. So the next item here is goods on consignment. So consignor is going to be the actual person who owns the goods. The consignee is the person who is selling those goods for the owner. So I don't know how many of you are familiar with downtown Lufkin, but we have a consignment shop in downtown Lufkin called Furniture Fetish. And it's where people will sell their furniture if they're having a hard time, say, selling it in the paper or selling it on Facebook or some other means. They may take it to this consignment shop, and they will tell the consignment shop, if you can sell this, we'll let you keep a portion of the proceeds, and then we'll take the rest. So I don't know what the exact terms are, as I've never sold anything through them. But I would imagine it's something like the consignee, in this case Furniture Fetish, would receive maybe 20% of the proceeds, and then the consignor would receive 80% of the proceeds if they can sell it within 60 days or whatever time limit the two parties agree on. But this is what is called consignment. So it's when a party sells goods that actually belong to someone else for them to help facilitate the transaction. So it's a consignment relationship. So the question here is, well, whose inventory does that actually get included in? And the answer might surprise you, but it is actually the consignor. So the person who actually owns that, even though I've given it in this example, say, to the company Furniture Fetish to sell for me, even though they have it in their warehouse or they have it on their showroom floor, it is not going to be included in their inventory count. And that's because they don't have the right to that inventory if I decide to take it back. So the merchandise in a consignment operation belongs to the consignor. The consignee just facilitates the sale. And because of this, the consignee will never report those consigned goods in inventory. So you end up with an interesting situation if you have an operation where they do some consignment, but they sell some of their own goods. In this case, what you need is really tight internal controls to make sure that you're able to identify properly the goods that you own, that are yours, that you are entitled to as the business, and those goods that you have accepted on consignment. So it's not uncommon in large warehouses for stores that do this to actually have large areas roped off and labeled consignment items or whatever they want to call it, but being very clear, these items should not be included on our inventory in our balance sheet, while these items over here that are not on consignment that we actually own, those should be listed on our balance sheet. So it's a very important area to understand. The next thing we want to look at is, well, what do we do with goods that are damaged or obsolete? So damaged or obsolete goods will not be reported in inventory if they cannot be sold. So here's the deal, right? If you imagine Apple, okay, 10, 12 years ago, whenever they first came out with the iPhone, right? At that time, an iPhone 1 was the hot ticket. Everyone wanted one. You couldn't get them. They were super expensive, all that stuff, right? But now, if Apple looks around and finds they have, say, 1 million iPhone 1s, right? The original iPhone back in some stock, do you think that's going to be worth very much now? Do you think they're even going to be able to sell it? And the answer is probably not, right? Those older iPhones, especially all the way back to the very original one, can't run the new operating systems. They can't run the new programs, the new apps. They can't do any of the stuff that people want their phones to be able to do now. So they're probably not that useful to be able to be sold unless someone just wants them as a collector, right? So they might have value to a few people, but the majority of people who are really just wanting a phone that can operate and do the new things aren't going to be interested in that iPhone 1. So it's going to be very difficult, maybe even impossible, to sell that million iPhone 1s. So those would be goods that have gone obsolete. It's extremely common in any technology area to see obsolescence occur quite rapidly. So within just 2 or 3 years, a lot of technology goes obsolete from the time it comes on. It's super exciting, it's super new and cutting edge. Within a year or two, it's already in the back of the pack unless they've updated more. So there's all kinds of different things that may go obsolete. Technology is just the easiest to understand. Now, of course, damaged or obsolete goods which can be sold are included in inventory, but notice this is one exception, not at cost, at net realizable value. So what we're saying here is if it cost them, say, $200 to build an iPhone 1, right? When they did that, they would have gone into inventory at $200. But now if we can only sell them at $150, well, it doesn't make sense to list them at 200 on my balance sheet. So I've got to actually write them down. So we're going to write them down to what is called net realizable value, which is known as sales price minus selling costs. This results in a loss that is recorded when damage or obsolescence occurs. So we could be looking at a loss here. Note, you will not be looking at a gain here ever. Now, the next thing we want to do is look at determining the cost of our inventory. So a couple of things we need to consider here. One, the invoice cost. Is that important? Certainly it is. So I don't want you to get so wrapped up in all the other stuff that you forget the most obvious piece, right? If the price tag says $500 for something, that certainly has to be included. But there are some other things we should consider. The first one is discounts. We should be removing any discounts, as we saw back in chapter 4. Those reduce the value of that inventory. And we went through those journal entries there, so I'm not going to rehash them, but that is what we see. We then add in any other costs, and you say, well, gee, that's specific. And I agree with you, right? It's not the best phrasing, but there's so much stuff that falls in here. Just a few examples include the items below: shipping, storage, insurance, and import duties. All these different things may be necessary to receive the inventory and to get it in a condition ready to be sold. And for that reason, they must be included in that cost of inventory. Now, when we are dealing with inventory, we have to be careful. Okay, so this is where we really talk about this idea of internal controls again. So I believe we talked about internal controls a little bit back in chapter 1, and we talked about things like the fraud triangle and basic internal control policies. But here we're going to look a little bit more detailed at exactly what we can do here. So most companies will take a physical count of inventory at least once a year, and once again, that is required by US GAAP. Even with a perpetual inventory system, you must still do that. Many companies will take more than one physical inventory throughout the year, but you must take at least one. Now, if you're not publicly controlled, right, if you're privately held with just a few family members or something, you probably want to be taking inventories, but it's not required unless you have a debt arrangement with the bank that says you must take a physical inventory once a year. Then in that case, of course, you would have to do so. But you're not required by US GAAP in that case to do so. Now, when the physical count does not match the merchandise inventory account, you must make an adjustment. Okay, this isn't something we can just say, oh well, it's close enough, right? We'll just say it's good, right? No, you can't do that. You're not allowed to do that. So this is what we need to do: is we need to ensure that we're doing everything we can to minimize those differences in what we count and what we actually think we should have. So some internal controls we're going to want to look at here include things like pre-numbered inventory tickets, counters, of course, not being responsible for the inventory. So here's the deal, right? I'm the manager in charge of all of the inventory for our company. Should I then be the one to go around and audit that and say, all right, we were supposed to have 13 of product number 1. Yes, we've got 13. We were supposed to have 12 of product number 2. Do we have 12? Yes, we have 12. Should I be the one doing that if at the end of the day, it's my responsibility to make sure we have everything? What do you think? Probably not. Because even if I'm moral and ethical and everything else, there's always that temptation for me to say, okay, well, I was supposed to have 12 of product number 2, but I've only got 10. Close enough. And to go ahead and mark that off and move on down the line. Now, hopefully I wouldn't do that, right? Hopefully, if you hired me to be over this, I would have enough integrity to say, all right, look, there's 2 missing. We need to find out what happened. But that may not always be the case. Depending on the environment at the organization, depending on everything else, my own personal morals and ethics, who knows? But there is the chance that I would be tempted to fudge those numbers. Of course, we don't want that, so you want an independent person actually doing this. So if I'm in charge of the inventory, I probably shouldn't even be there as this is happening, unless they'd say, don't know where something is supposed to be. Then they can call me and I can say, oh, well, look on the 3rd shelf from the left. It should be on the 2nd row. And they say, oh, okay, yeah, there it is. But I shouldn't be the one actually doing the counting, because it does introduce that element where there is the possibility of someone to actually start to hide some stuff in this count. Now, of course, next, whoever is doing the counting should know enough about the product or the items to be able to accurately identify them, which means they would then be able to actually confirm the existence, amount, and condition of inventory. So here's the deal. I don't know very much about heavy machinery. If you sent me out to look at a bunch of heavy machinery and they told me this item right here is item number 124, I wouldn't have any idea if that was item 124 or not, unless you gave me some kind of information as to how I would identify that product. So maybe there's a VIN number, maybe there's a serial number. If there's something like that, then sure, I can do that. But if we're just looking at individual items that aren't super expensive or anything, maybe they only cost $50 or $100, and they don't have individualized ID numbers, then it may be much more difficult for me to actually confirm that this is what you're telling me it is, unless I have some experience in that area as well. So you want to make sure whoever is going around doing this inventory count can actually tell the difference in the different items. You'll then want to know how these things are supposed to be counted. Do they come in pairs? Do they come in 3s or 4s or singles or whatever, right? How do we count this? How is it normally counted so we can make sure we have the correct amount? And then is it in good condition, or has it been banged up? And what this really means with the existence area of this is a lot of times when you're counting, it's very easy to look at something and say, okay, well, that's 7 shelves up, way up there. That box weighs about 100 pounds, and I don't feel like dealing with it. So I'm going to get a stick. I'm just going to nudge it a little bit and see if it feels about right. If it feels pretty heavy, then it's probably fine. Right? The stuff's probably in there. But you shouldn't do that. You need to go get the ladder. You need to open the box up. You need to look inside of it and make sure that what is in there is what's actually supposed to be in there. Because how can you tell without doing so if that's actually got the product or someone just tossed a bunch of bricks in a box and put it up there? You can't. So you've got to go through that extra step. Now, of course, it's always a good idea to get a second opinion. So you may want someone else to come behind and actually count this. You wouldn't want the two counters communicating though before or during, right? You would want counter number 1 to go do all their counting, report it, write it down, turn it in, whatever the case is, and then have the second one who has no idea what the first one got go through to the same thing, and hopefully at the end those two people match up. And if they do, that should give you a little bit of added confidence that this count is actually correct. And finally, you would want the manager to actually go through either recounting or just re-looking over all of the information to making sure that everything does look correct. In this chapter, there's 4 main methods we're going to be talking about. The 2 biggest ones that we're going to be using are what are called FIFO and LIFO. The other 2 that we will deal with briefly are called specific identification and weighted average. So what we need to realize is with the first 3, FIFO, LIFO, and weighted average, we need to understand what they are telling us. So FIFO, right? You will hear me refer to this as FIFO from here until the end of time. I will almost never call this first in, first out. I'll simply say under FIFO, right? And hopefully that triggers with you this idea that we are talking about first in, first out. So what this tells us is the first objects that we purchase for inventory are the first objects that we sell. Under LIFO, which is of course the opposite, which means last in, first out, it is the opposite. So the last objects I purchase are the first objects I sell. And under weighted average, we take an average and we then use that average with each sale. So first things first, we're going to look over here at FIFO. In this case, they tell us we had net sales of $100 and our cost was $45. So that means we must have sold this layer. That layer comes down, gives us gross profit of $55. Our ending inventory then is simply what we did not sell. The 70 plus the 65 gives you a total of $135 left in your ending inventory. Now, under LIFO, we flip this around some. So under LIFO, the last one in, right? So May 1st was first, May 3rd, and then May 6th. Well, the last ones in were those purchased on May 6th. Under LIFO, last in means first out. So what this means is this $70 will come down into cost of goods sold. You'll notice this leaves us with a gross profit of only $30 and ending inventory of $110, which is the sum of the May 1st and May 3rd purchases. Now, comparing FIFO and LIFO, what you will notice is that in this case, prices are increasing over time. When this happens, FIFO will give you a higher level of gross profit and a higher level of ending inventory, as well as a lower level of cost of goods sold. And that is because the goods you are selling are those first goods in that came in at the lower price. Under LIFO, of course, the opposite is true. Because you are first selling the goods that came in last, they came in at the higher price in a period of rising prices, which is, of course, common since we typically see inflation and not deflation. So we see this happening where we pull down the $70 cost for cost of goods sold, and we take that from our $100 in sales, leaves us with only $30 in gross profit versus $55, as well as our inventory balance is significantly lower. Now, the trick here is under weighted average, I want you to notice where gross profit, cost of goods sold, and inventory ends up. Okay, notice that cost of goods sold of 60 is between 45 and 70. Gross profit of 40 is between 30 and 55, and inventory balance of 120 is between 110 and 135. So here's the deal. with weighted average. Your information that you get should be somewhere in the middle of FIFO and LIFO. Please be careful and please hear me carefully. I am not saying that this will be directly smack exactly halfway in the middle. That is not true. But it should be somewhere between those two items. Could it be closer to the FIFO number? Sure. Could it be closer to the LIFO number? Sure. It really just depends on how the prices changed. So the way the math works here, under weighted average, you're simply going to take an average. 70 plus 65 is 135, plus 45 is 180. 180 over 3 is 60. 60 times 1, because you sold a one item, comes down to cost of goods sold, which gives you gross profit of 40. 60 times 2 gives you an inventory balance, or an ending inventory balance of $120. So that is what we see here. Now, once again, we're back to our favorite chart. This is now the third chapter in a row, I believe, we have seen this chart. So a very important chart, and one you definitely should be getting familiar with, hopefully by now. So we take our beginning inventory plus our purchases. Of course, this gives us merchandise available for sale or inventory available for sale. Of this, it has to go into one of two buckets. All right, inventory does not stay in merchandise available for sale. It has to go one way or the other. So the first way it can go is it can go nowhere. It can stay in ending inventory. If it does that, this is, of course, on our balance sheet. That is where we will find our ending inventory. But if it is not an ending inventory, then it has been sold. And if it has been sold, it is moved to the account cost of goods sold, which, of course, is found on our income statement. Now, first thing we want to look at is inventory costing under Perpetual. So I want to make one quick note here. Physical flow does not need to follow cost flow. Okay, it sounds kind of weird, but we'll see exactly what that means. So once again, balance sheet will show your ending inventory. Income statement will, of course, show cost of goods sold. So first example here. Here's information about the mountain bike inventory of trekking for the month of August. So you will notice at the beginning of this, we had a total of 10 units at $91, which gave us a total of $910. Now, under purchases, right, on August the 3rd, we purchased 15 units at $106, which gives us an extra $1,590 in total inventory. We then sold 20 units at $130 and on down the line. So we can see exactly how this is working. So we're going to look at this first under our specific identification method. Note, once again, this is under a perpetual system, but specific identification is treated the same under perpetual or periodic, essentially because in either case, you know exactly which units are being sold. The only difference is the timing. So in this case, total cost of 55 units available for sale was $5,990. Okay? And we see that, of course, right here. So in total, we bought 10 units plus 15 plus 20 plus 10, which is a total of 55 units, had a total cost of just under $6,000. Now they tell us of those 55 units, 8 of those were from our original inventory at $91, 12 were from the purchase at $106, 2 more came at $91, 3 at $106, 15 at $115, and 3 at $119. So all we're going to do here is some product type stuff. So 8 times 91 is whatever it is. 12 times 106, those two numbers added together comes out to 2,000. 2 times 91 plus 3 times 106 and on down the line comes out to 2,582. This tells you then your total cost of goods sold is 4,582. And remember, if we go back to our graph, if my merchandise available for sale is 5,990, my cost of goods sold is 4,582. The difference, this 1,408, I believe, is your ending inventory amount. So that is, of course, what we see here, and that is how specific identification works. So that one's pretty straightforward. It takes a little bit just because you got to be careful on the calculator and make sure you key everything in right. But as long as you use the calculator right, you should be able to get this one pretty much no problem. It should pretty much tell you exactly what to do. As it'll say, on this date, this sale was made up of units from this, this, and this, and it'll tell you exactly how that works. And of course, we'll work through some of these in class. Now, the next item here is first in, first out. So what this tells us is our oldest costs will be landing in cost of goods sold, and our more recent costs will be landing in ending inventory. Now we've got a fantastic chart for this that we'll go over in class, but for now, we will simply look at how the problem works. So these tables, I believe, are how this is asked in your homework assignment. So it's a very good idea to get comfortable with how these work. So I'll try to go fairly slowly through this just to make sure we understand how it's functioning. And then we'll pick up speed later on in the video as we've done several of these toward the end. So first in, first out, we've got our beginning balance in August. The first 10 units at $91 gives us a total inventory balance of $910. Now, on August the 3rd, we purchased 15 units. So this is the number of units. This is the price per unit at $106 per unit, and gives us an extra $15.90. At this point in time, our inventory balance has two layers. It has the original 10 units at $91, which simply comes straight down, and the new 15 units at $106, which simply comes straight over. So at this point in time, we've got a total of 25 units with a total valuation of $2,500. Now on August the 14th, we made a sale. It looks like we sold a total of 20 units. But under FIFO, what we see is the first ones in are also the first ones out. So when it comes time to make my sale, the first units I sell are these 10 units at $91 from this inventory balance account. Why do I sell only 10? Well, there's only 10 in that layer. So I can't sell 20 units at 91 because I only had 10. So these 10 units at 91 will have to come down, and we'll end up getting marked out there. Let's see if we can. So the 10 at 91 will simply come down and goes right here. Now, on the next part, we sold 10 more units because we sold a total of 20. So to sell a total of 20, if I've already sold 10, I need 10 more, which means 5 of these are left. So if I've got 5 here, those 5 stay in ending inventory, while the other 10 come out in cost of goods sold. This leaves you $1,970 in cost of goods sold and $530 as your new ending inventory balance. Now I want to point one thing out. On each layer, every time you have a sale, so on this row, for example, what I would recommend is that you take the time to actually highlight your 530 and your 1970. Go ahead and plug those back in your calculator. Make sure you're coming back to the number directly above. If you are, that means you have at least allocated everything. Does it mean you've allocated everything properly? No. Sure, it doesn't, right? You could have made a mistake. But it does at least mean you've given yourself a chance for that row to be correct. Because if before this sale happened, you had 25 units totaling out to $2,500, you should now have 25 units totaling out to $2,500. It'll just be split between cost of goods sold and ending inventory. And in this case, you've got a total of 20 units here. You've got a total of 5 units here. So there's your 25. And it just so happens if you add your 1970 and your 530, you will come out to $2,500. So it looks like that row has been done properly. Now, on the other side, we are looking here and we purchased 20 more units. Now your ending inventory is still made up of these 5 units at 106 plus your 20 new units at 115. That gives you now a new ending inventory of 25 units valued at a total of $2,830. On August 28th, of course, this bunch comes straight down, so nothing has happened to them, and now you're simply adding in 10 more units. At this point, you've got a total of 35 units valued at a total cost of $4,020. Now, the last piece of this question deals with one final sale. So, for the last part here, we are selling 23 units. Remember, FIFO, first in, first out. So, it's very important to keep these items in the correct order, as keeping them in the correct order allows you to very easily tell which ones are the oldest. So, first in, well, top row. 5 at 106. I simply knock out all 5 of those, reducing this to 0. Right? We've got no units left there. Now, if we sold a total of 23 units, that means I need 18 more. So if I need 18 more units, that means my 20 goes down by 18. I now have 2 units at 115, and I still, of course, have my full 10 units at 119. So 2 at 115 is 230, plus 1,190 is 1,420. That 1,420 will then be added to your 2,600. When you add those two numbers together, you will come back, of course, to the previous row total of 4,020. That is how you check the dollar amount. To check the actual number of units, what I would recommend is doing the following. And I would check both to make sure you've tracked everything through. It's very easy to lose something in all of this. Here you had a total of 35 units. So if you had a total of 35 units, that means between here, your cost of goods sold, and your ending inventory, you should now have 35. Well, if you have 12 in ending inventory, and you have 23 in cost of goods sold, 23 plus 12 is in fact 35. So you know you've allocated all of your units and all of your dollars properly. So that is how we handle FIFO under Perpetual. Now I'll tell you really quickly, there is a shortcut method. If you wanted to do it, here is the way you do the shortcut. Okay? Now on the exam, I think it asks you for this table if you're taking it in Connect, so you can't really do this other than to check. If you're taking it in class with me, I give you a big blank area. So if you want to use the shortcut method, you can. So kind of goes back and forth. I think there's benefits to both types of exams. Depending on the semester, your class may or may not be taking online exams. So it's more useful, this trick, of course, for the paper exams, but it is still useful enough for the online exams as well. So in this case, what you want to do is figure out that you had a total of 20 units that were sold originally, plus 5 is 25, plus 18 is 43. So in total, what you need to figure out is all of your units. So in this case, you had 10 at 91. You can simply knock out all 10 of those, knock out all but 5 of these. Then you come down, you say, okay, well, we needed 5 more, so now this layer is completely gone. Then you take 18 out of here, and you can actually recreate this. It's a little bit cleaner on paper where you get all the information given in an original table, but you can very quickly identify which units are left and which units are still in the inventory versus cost of goods sold. So there is a shortcut method. It's a little bit easier to show in class. So if you do want to see that, I don't mind showing you all that on the paper in class. Just ask me, and I'll be happy to do that or dig up a problem that we can show that with. But the way the information is given here is a little bit awkward to show. So we'll continue on for now. So that is, of course, our FIFO method. Now we will move on to our next method. So let's see, our next method then is LIFO. I want you to notice here that the recent costs under LIFO land in cost of goods sold. But under FIFO, that was the oldest cost. So it's a complete flip. Now here, your oldest cost ending in ending inventory, whereas under FIFO, your newest costs were in ending inventory. So it's a little bit different how this is going to work. So here with LIFO, we've got our beginning balance 10 at 91. I want to point out something that is very important with the FIFO method. So with the FIFO method, you must identify if we are talking perpetual or periodic. Now, most cases we will be dealing with perpetual, and what that tells me is time matters. It matters when a sale occurs versus when a purchase occurs. In the case that we are dealing with periodic, time does not matter in the slightest. We simply update at the end of the period. So when I'm doing LIFO, I can start straight at the bottom and go straight up. But when I'm dealing with perpetual, those dates are absolutely crucial, and we'll see that play out here. So once again, we've got our same beginning situation, 10 at 91 plus 15 at 106. Nothing has changed here. This is the same. But notice on August the 14th, when we made our sale, we sold 20 units. But did we sell these 10 units at 91 first? No. Remember here, last in, first out. What that tells us is the last units in were these 15 at 106. All 15 of these must be sold first. And so that is what happens. Next, if we're trying to sell a total of 20 units, then I need to sell 5 of these at 91, which leaves 5 in ending inventory. So 5 in ending inventory pull down, and 5, of course, go down as cost of goods sold. So in this case, our cost of goods sold is $2,045. $2,045 plus $455, of course, totals back to $2,500. Okay. Now, on the next row, we want to look, and we see that now we purchased 20 at 115, those simply pull in, and 10 at 119, those simply pull in. For our last piece here, we sold 23 units. Those 23 units are, of course, made up first of the 10 units at 119. So that comes out first, last in, first out. Next, we need 13 more units. Well, those 13 come from right here, which leaves you with 7. So those 7 units will find their way to ending inventory, and these 5 units will find their way to ending inventory. At this point, all that's left is to make sure everything totals out. So when I come in, 5 times 91 plus 7 times 115, 1,260. 1,260 plus 2,685. If you add these two numbers together, you will, of course, total back to 3,945. Now, if you want to check your unit computation, once again, this right here, 5 plus 20 is 25, plus 10 is 35. So you need to be dealing with 35 units. Well, here 23 have been sent to cost of goods sold, and 12 are left in ending inventory. 12 plus 23, of course, does equal 35. So you can check, and I recommend once again that you do check both the dates and the units as well as the dollar computations. Now, you say, well, why did the dates matter? I want to point something out. If this was LIFO periodic, I would have started with my absolute oldest purchase, which would have been the 10 at 119. That is my absolute oldest purchase, right? Or my absolute last in purchase. So because these were last in under a periodic system, I could have sold these 10 units that I got on August 28th in my sale on August the 14th, because I wouldn't be updating anything till the end of the period anyway. But under Perpetual, we realize dates do matter, which means on August the 14th, the last inventory that is in at that point in time is from our purchase on August the 3rd. And on our sale on August the 30th, the last units that were in at that time were these from August 28th. So that is why dates matter so much under a perpetual system with LIFO. Now, the truth is with FIFO, periodic and perpetual will give you the same exact answer. So in that case, if you want to treat perpetual FIFO just like periodic FIFO, feel free to do so. Now with weighted average perpetual, which is of course our next section, we are looking and we see when a unit is sold, the average cost of each unit in inventory is assigned to cost of goods sold. So the cost of goods available for sale divided by the units on hand on the date of the sale. So let's look here. We see at the beginning we have our beginning balance, 10 at 91 equals $910. Of course, at that case, we've only got one layer of inventory, so we have exactly one cost. So the average is pretty easy. On August the 3rd, we had 10 units at $91 plus 15 units at $106. This gives us $2,500 for a total of 25 units, which of course gives us an average rate of $100 per unit. You'll notice now on the next row, August the 14th, we don't pull through our layers, we're simply pulling through our average. So we see that coming down. So we sold 20 units at 100, so we pull that through, and we had 5 units left at $100, and that's it. So it's a little bit more clean because you get rid of a lot of these layers. Now, to determine the cost, of course, we see what we just did. Okay. Now, after that, we come in on August the 17th. You've got these new units, 20 at 115, plus your 5 at 100. That gives you 25 units at a total of $2,800. That gives you a new average of $112 per unit. Now that 112 will pull down 25 at 112 plus 10 at 119. So 39.90 over 35 gives you a new average of 114. Now in your final row, when you sell 23 units, you simply take the 23 times 114 for 2622 and your 12 times 114 for 1368. Now once again, you can add everything back. 2622 plus 1368 is 3990 and 2000 plus 500 is 2500. Then you can come in, 12 plus 23 is a total of 35 and 5 plus 20 is of course a total of 25. So everything still adds just as it did before. Now, in the next part, we want to look at how this all affects our income tax reporting. So the first in, first out ending inventory will approximate current cost. And that's because the first ones in are the first ones out, which means the last ones in are still here. Those last ones we bought more recently, so they have a more current cost. Now for last in, first out, cost of goods sold on the income statement, of course, will approximate current cost. And that is because the last ones in had the higher or the newer cost. And that is being treated as the first ones out. So we're selling those first, so we get a little bit more accurate cost of goods sold number under LIFO. And of course, weighted average is really nice if you have unusual fluctuations in prices. It helps you to actually see that become more smooth. Now, in this case, we're comparing all of the information that we've gotten from all of our calculations, and I want to point out a couple of things here. Notice between FIFO and LIFO, FIFO had the highest level of net income, while LIFO had the lowest. Weighted average is somewhere in the middle. Truthfully, I wish your textbook would simply switch weighted average and LIFO in their columns so you could very easily see those numbers are somewhere in between all of the numbers for FIFO and LIFO. Now, one thing I do want to point out here, specific identification in this case was somewhere between LIFO and FIFO. That is not necessarily always the case because it simply depends on exactly which units got sold. So specific identification could give you an amount higher than FIFO for net income, or it could give you an amount lower than LIFO for net income. You never really know. It just depends. But these other three do work in a way that kind of makes them make sense. Now, if I asked you which of these would you want to use for income tax reporting, which one would you want to use? So, if my only goal is to minimize the amount I pay the government for taxes, what I should choose is LIFO. Because if you look, with LIFO, we are only having to pay a total of $261 in income tax expense. Whereas with FIFO, we're having to pay over $300. And with weighted average, of course, it's somewhere in the middle. So if my goal is to minimize tax payments, LIFO is the way to go. But do you think my shareholders are happier seeing net income of $609 or $721? So here's the issue management has to battle with. Your shareholders tend to like to see net income be higher. But the government says if your net income is higher, then you did better. And if you did better, we did better. So congratulations, we all win. We get to tax you more because you have more earnings that are taxable. So the issue is, if I could, I would want to use LIFO anytime I'm reporting to the IRS, and I would want to use FIFO anytime I'm reporting to my shareholders. But do you think this is allowed? What do you think? Okay. So the government realizes this, of course. And so what they say is, we're not going to let you do that. right? If you choose LIFO to pay lower income tax, that's fine, right? That is okay. But what we're going to say is you can't then turn around and use another method for your financial reporting. So when you're reporting to your board of directors, when you're reporting to your shareholders, or going to get along with the bank, or issuing bonds, or anything else, you must also use LIFO and report that lower net income. This is what's called the LIFO conformity rule. It's very important that you understand what it is, because it is almost always a question on your exam. So do be aware of the LIFO conformity rule, which simply tells us that if you use LIFO for tax reporting, you must also use it for your financial reporting. Okay? So with that, we will continue on. Now, one second. Let's get rid of these highlights real quick. Now, here we go. They are now talking about that LIFO conformity rule. So, of course, when LIFO is used for tax, it must also be used for financial. Okay, so very important idea, very important concept. Now, the next idea is what we call lower of cost or market. So, what this tells us is that inventory must be reported at market value when market value is, notice, lower than cost. Notice the name here, lower of cost or market. It's not higher of cost or market. It is the lower of the two. Remember in chapter 1, we said inventory, specifically an asset, but in this case, we're concerned about inventory, must be reported at cost. That was called the historical cost principle. And that is still true. But the issue is, when historical cost isn't accurate anymore, we might need to actually write this thing down. And so this, of course, occurs when we have things like technological obsolescence. Think back to the iPhone 1 example, right? You may not be able to sell it at full price. You may not be able to really recover all of those costs. So we need to actually fix this. So here, our market is simply defined as the current replacement cost, not the current sales price. So this will be consistent with conservatism. So I think this makes a little bit more sense if we actually look at an example. So we'll do that, I believe, on the next slide. But we see here, we can apply this in one of three ways. It doesn't matter as long as we're consistent. So we can either apply this to each individual item we have, to major categories, or to everything all at once. So in this case, our inventory is made up of 2 items, Roadsters and Sprints. We've got 20 units of Roadster and 10 units of Sprint. Notice the cost per unit for the Roadster is $8,500, while the market value is $7,000. So in this case, we'll simply take our 20 times 8,500 and our 20 times 7,000, come out to our two amounts, 170 and 140. Lower of cost or market applied to that on a per item basis, well, we decide for the Roadster to pull through the 140, because 140 is, of course, less than 170. We'll do the same thing for the Sprint. 10 times 5 and 10 times 6 gives us 50 and 60. In this case, our cost is less than our market, so we'll keep this at cost. 140 plus 50 is 190. But you'll notice the total cost originally was 220. So we were at 220. Now we are needing to value at 190. What that tells me is I need to write down my inventory. Well, remember that chart, right? When we talked about inventory, we said inventory has to be in one of 2 places. It is either in ending inventory or it is in cost of goods sold. It has to be in one of those places at all times. So if I'm writing down my inventory, that is a credit to inventory. But if inventory goes down, then cost of goods sold must go up. And that's what we see here, a debit to cost of goods sold for 30, a credit to merchandise inventory for 30. Now, I'm not super concerned that you really understand this. This slide is very complex. It only is going to be 1, maybe 2 multiple choice questions on your exam. So if you look at this and you say, this is just weird, I don't like it, that's fine, right? If you want to come talk to me about it, I'm happy to go through it again with you in my office or by email, through a Zoom meeting, whatever. But a lot of people don't like this, and that's okay. It's not going to make or break your exam. I don't want you wasting hours and hours trying to understand cross-period effects on inventory errors on the financial statements. So if you can do it, if it makes sense to you, fantastic, right? It's probably going to get you a couple extra points on the test. If you can't, focus on the other stuff. and you'll be all right. So here's the deal. What happens in two scenarios, okay? If inventory is properly stated, then none of this matters. And if inventory is properly stated, there is not an inventory error, so everything is just correct. But in the case that inventory is misstated, it can either be understated or overstated. So those are our two options. In the case that ending inventory is understated, right? If ending inventory is too low, then cost of goods sold is too high. And if cost of goods sold is too high, then net income is too low. And if net income is too low as a result of that ending inventory being understated, right, which is where we've come so far, then what that means is that next year's beginning inventory is understated, which means that next year's cost of goods sold is understated and next year's net income is overstated. So it moves through, but you'll notice it pretty much corrects itself over 2 years. Notice in year one, we ended up with a situation where cost of goods sold was overstated, and in year two, it was understated. In year one, our net income was understated, and in year two, it was overstated. So this will eventually correct itself on its own. All the same logic applies in reverse if we have ending inventory overstated. They go ahead and follow through some of this in the math down below. But like I say, I'm not too concerned that you really understand the ins and outs of this. I think there's too much other stuff for us to focus on. So for the sake of brevity, I'm going to move on. But as I said, if you do have any questions, feel free to come by. I'm happy to talk with you about it. We'll look at an example or do anything we need to for you. But basically what you need to understand on the income statement is what we just covered. On the balance sheet, this is the case. If ending inventory is understated, then assets are understated. And if assets are understated, then equity is also understated. So the balance sheet's a little bit easier because really what you got to understand just at a high level is, remember, assets equal liabilities plus equity. If one of my assets is understated and is not having any effect on liabilities, then of course equity must also be understated. So it goes in the same direction. In the case where ending inventory is overstated, of course, both items, assets and equity, are overstated. Now, the next section we want to look at and deals with some of our ratios. So we've got inventory turnover. This simply shows us how many times we turn our inventory over during the period. This tells us essentially how well we are controlling inventory available. So we simply are going to take our cost of goods sold over average inventory. At this point, you're probably saying, well, what on earth? How do I calculate average inventory? And thankfully, that's right below. Average inventory is simply equal to your beginning inventory at the end of the period. At the beginning of the period, plus your ending inventory from the end of the period. Add those two numbers together, half it, and you've got your average inventory. Now, what if I only give you ending inventory numbers? How do you do this? So say I give you ending inventory for year one and ending inventory for year two. Well, you're going to have to rely on that relationship that we talked about. Remember, ending inventory for year one becomes beginning inventory for year two. So at that point, you would take your ending year one and your ending year two, add those two together and divide it by 2. So either way, right, regardless of how the question words it, you will normally be able to figure this out. Now, the next is the first of many days formulas that you will see throughout the semester. The key to remember when we are dealing with any formula with the word days in it is at the end you will multiply by 365. If you do not multiply by 365, this formula will make no sense. So this simply tells us how much inventory is available in terms of the numbers of days sales. So I'll take my ending inventory, divide by my cost of goods sold. That'll give me some number, and then we will multiply that by 365. If that comes out to 18, then it tells us we've got 18 days worth of sales currently in inventory. Maybe that's enough, maybe it isn't, but that's what it would be telling us. So here we're going to look at this. We have Costco versus Walmart. So for Costco, they actually gave us enough information to be able to calculate this, at least for some of the years. So what we see then is for Costco, their inventory turnover as of 2 years ago is 11.6, 11.5, up to 11.9. So we can see they are improving, albeit slightly. They are improving a little bit. So they are getting through their inventory very efficiently. Their days sales in inventory is pretty much dead on at 32 days every year. So they've got very consistent management, right? They're keeping this very tight Maybe they want to have that. I don't know if that's a good amount for a grocery store or not, but I guess it's fine. They seem to be doing well with it. So that's where they are. Now, on the other side, we've got Walmart. Notice their inventory turnover of 8.1, 8.1, 8.3. You say, well, Walmart's inventory turnover is much lower than that of Costco. But I want you to think about what the two stores sell. Now, I'm not super familiar with Costco, but I think Costco is primarily just food and perishable items, primarily food, vegetables, drinks, all that kind of stuff. Whereas Walmart has a lot of stuff that isn't like that. They've got clothes, they've got some auto parts, they've got some hunting gear. They've got all kinds of stuff that you might not be able to find in a Costco that may not turn over as quickly. So it may make sense that Walmart's inventory turnover is slightly lower because they're involved in a lot more than just regular groceries. So it may or may not hold. If you know a lot about Costco, maybe I'm wrong. Maybe Costco is really just doing a better job managing their inventory than Walmart, which very well could be part of this. But at the same time, it may simply be the stores are made up of simply different levels of inventory, different types of inventory, and that may be what we're seeing here. So of course here, with the lower inventory turnover, we are of course seeing the higher days sales in inventory for Walmart as compared to Costco. So we do see that. And with that, that officially wraps up the end of chapter 5. So if you have any questions, once again, please don't ever hesitate to come by my office or shoot me an email. I'm happy to get back with you. But if you are an accounting major or a minor, I do once again recommend that you review the periodic information here at the back of the chapter. But for anyone else, it is not likely to be tested. Once again, if it is tested for whatever reason, I will be sure to review y'all on that in class and make that well known in advance of the exam. So if you have any questions, please let me know. I'm always happy to help you. Thank you.